Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, today we are going to talk about this ridiculous chart that the King of the Crash Bros put out. What we're going to do is we're going to, and if you look at the chart, it's been scaled in such a way to make it look like housing is just out of control. It's not. We're actually going to go over all the numbers. We have all the numbers from the 50s all the way to today, and we're going to compare homes from the 50s to today and adjust for inflation. We're going to go through all this, what wages were, and you're going to actually be shocked when you find out that actually not much has changed in the last 75 years in the U.S. housing market. Okay, Juana, let's do this. We're going to break this video up into a couple things. We'll first compare buying a house in 1950 and what that meant.
Okay.
What that product was like versus today.
Okay.
And then what we'll do is we'll go over what incomes were, like what percentage of income your mortgage payment would have been then, because we have all the numbers. Because he put them on the chart, and we know what wages were, right? And we know what home prices were, or home payment. And then what we'll do is we'll go through the overall housing market and the numbers, because what he does is he's got this ridiculous $2,800 a month, and which isn't an accurate representation of all people who own houses, right?
No, of course not.
Okay. All right. So let's start with this. Juana, first of all, pretend it's 1950. You're buying a house, brand new house, let's say. How big is that house, do you think? A house from 1950?
A house from 1950 is going to be somewhere between 1,000 to 1,200 square feet.
Okay. So 1,000, 1,200 square feet, it's probably going to have, how many bedrooms, bathrooms?
It'll have 2 to 3 bedrooms. It will have 1 bathroom.
Oh, 1 bathroom.
It will have a kitchen and a living room, but you're not going to have a den, a family room, or any other amenities. The house is going to be very basic. It's going to be a basic rectangle. It's going to sit on a little bit of land. You're going to have a backyard, a front yard, picket fence, whatever, a dog, cat, and June Cleaver is going to be baking you cookies.
Okay, do you happen to know about how big the average house is today?
So the average house is about 2,500 square feet.
It is. It's exactly 2,500 square feet. The average new home in 1950 was actually about 1,000 square feet.
Okay.
It was a 2-bedroom, 1 bath on average.
Okay.
There were some 3 bedrooms. In a 2-bedroom, like what my mom grew up in, the girls shared, she has a sister, they shared a bedroom.
Right.
And then the parents had a bedroom. So, or sometimes it's like 3 girls sharing a bedroom. So, okay, that's the first thing. The product is not the same. So when you, first of all.
Well, hang on. A little more.
A little more?
Okay. So let's talk about things like heating, air conditioning, all those things that, do they have heat? Yes. Did they have air conditioning? No.
Certainly not.
All kinds of other amenities that make our homes what they are.
Heating wasn't central.
No.
It would have been central heating. It would have been a fireplace or the individual wall heaters where they're electric and you turn them on and they just get hot.
Right. Radiators, that sort of thing. Yes.
Right. What about land scarcity, location demand? It's 1950. You're in San Diego or wherever. Let's say Orange County. Orange County is a good example. 1950 in Orange County. As you're driving through Orange County, is it just packed with houses?
It is not. It is still farmland.
Oh, it's still farmland. So land was pretty cheap back then.
Land was pretty inexpensive. And not only was land inexpensive, but there weren't the amenities. Okay, so besides land being inexpensive, even in cities, unless you're someplace like San Francisco or New York, there really weren't that many amenities even in the cities. The cities were much smaller. They didn't have that many amenities. They didn't have as many opportunities, right? So it's kind of like comparing maybe, as politicians call it, is flyover country, right?
Right.
Middle America to the coast, right? I mean, it just completely different environment, completely different housing stock, completely different economic opportunities, completely different density numbers for population.
Okay.
Just all sorts of differences in that way.
Construction costs. Labor was much cheaper. House was cheaper to build.
Well, a house was cheaper to build, not just because labor and materials were cheaper, but like I said, what you got was not the same quality. You didn't have the same amenities.
Right. You just had, like, it was a square, and a lot of
Right.
times they were cinder blocks.
Sure.
And then sometimes they were built on top of something so they could put plumbing and stuff underneath. But you didn't have like, fancy windows. You just had a square that they would stick a window in that maybe leaked or whatever, right?
Well, hopefully
like
it didn't.
Air got in or whatever. Okay, what about, what were some drawbacks of a house in the 1950s versus today? Let's talk about like an average neighborhood maybe. Did an average person have a car, do you think, in 1950?
So, yes, but they didn't have as many cars per family.
Right, they probably had one.
Right, so they probably had one car per family. Maybe if you were, middle class or upper middle class, you had 2 cars per family, but you certainly didn't have more than that. The other thing is kind of going back to...
Did everyone have a garage, do you think?
Not everybody had a garage. And remember, they were building with asbestos, all kinds of things that we don't do today.
Okay, so the product, you can still go find those houses that were built in 1950.
Sure.
Now, the argument will be, but Todd, shouldn't they still be, adjusted for inflation, the same price? Well, no. If you're in San Diego, in Old Town, that area is much different than it was in 1950 because it's all been built out.
Well, it's all been built
out. And the land is what is extremely valuable, right? It's not really that little house, the 1,100 square foot house in Old Town San Diego.
Well, not only that, but it's not like you can, just go out a few blocks from that area and you'll have plenty of land. That whole area is built out. So when the whole area is built out, now you're talking about not having any available land to build. So the only way you can build is either you renovate or you tear down and build new.
Okay, we're going to go back to the chart. Now let's look back to the 1950s. You can see 1955, maybe 112, 123, was probably like 110, 108. This is the mortgage payment. That's what you paid per month. Now, Juana, the lowest interest rates ever for mortgages in the history of the country, outside of just like 4 or 5 years ago, were in what decade?
It was in the 1950s because the GIs came back from the war, and the economy was roaring, and people were buying homes, they were starting families, so there was a lot of economic activity.
Interest rates were low because there was a lot of business to be had.
Sure.
The lowest rates we've ever had, ever, were the 1950s. So one of the reasons why these payments are so low is because of that. Now, this is what's interesting. You're looking at this chart going, but Todd, this still doesn't make sense. Well, hang on. This is the fun part, okay? Okay. The average monthly income in the U.S. in 1950 was about $3,300 per year. Ready for this? Which is $275 a month. So if you've got a $110, $115 house payment and you're only making $275, isn't that about the same ratio probably as today? Like your house payment's like over a third. It's more than a third. It's somewhere between a third and a half of what you earn. Right.
So this tradition of house payments being less than 40% has basically been maintained throughout mortgage history over the last 70 plus years, because we know that those are Fannie Mae requirements for FHA loans and that sort of thing. So you see that kind of continuing. So because those percentages haven't changed, you kind of see that that it just progresses through the decades.
Right. Let's go look at something else here on this chart. Put the chart back up. It says it's $2,800 a month. Okay. So let's do this first comparison. The first comparison is how much. So it's $2,800 a month, but that's just for people originating like today, like the median house today, right? Okay. It turns out that the average family income in the U.S. in today, 2025, based on the Census Bureau, is about $6,700 per month. It's also possible there's some estimates about $6,500 per month, which is about right? Because family income, and we know that it's like $82,000 a year for the country for the median income. So this jives with that. This all makes sense, right? So $6,500 per month, all of a sudden, $2,700 per month. That's kind of the same ratio, right? It's less than half. It's more than a third. But when you look at the chart, see they've made, so what they don't do on here, he intentionally doesn't show what wages are doing. He's ignoring wages. Here's another example. This was a fun one. If you go back to 1980, okay, he's got this huge run up and says, oh my God, it was $900 a month in 1980, okay? In 1980, $900 a month mortgage payment, adjusted for inflation, we've had a lot of inflation the last 5 years, would be $3,430. So even that really high payment is still less than today. That $900 is still less than today.
Okay.
Right? It's less than today because today it's like $2,700. Okay, here's another thing, Juana. What percentage of people do you think own their house free and clear?
So it's been changing by a point or two over the last, I don't know, 5-6 years, but it's basically 40%, give or take a couple points.
40%, we actually have data. The last time it was actually measured, 2022, it was like 39.2 or something like that. And based on this linear progression, it's about 40.8%. This is just sort of the progression we've had since from 2012 to 2022. Like you said, it's been going up half a point to a point each year, free and clear. So 40% of people don't pay $2,700 or $2,600 a month. They pay basically zero, or you could say taxes, insurance, right?
Right, but this is, the question about this is mortgage payments. So mortgage payments, for our purposes, we're going to exclude tax and insurance.
Okay, and so let's just do that. Now, what about the other 60% of people who do have a mortgage? Do all of them now have to pay this new amount because interest rates have gone up?
No, so what those numbers are on the chart, those were the mortgage payments if they were originated that year, right?
Okay, so I'm going to put the chart back up.
Right, so that means that when you're talking about $2,700, whatever that is, that's for that year. So when you're looking at $900, those are the mortgages that were originated that year. When you're talking about $113, those are the mortgages originated that year. So when you're looking at what's happening in 2025, you're dealing with people that have had mortgages that were originated anywhere between today and going back technically, 30 years. And so you've got a really big difference right there between the people who originated mortgages 30 years ago versus today. And so all those are kind of lumped in as far as it gives the impression that everybody's making the mortgage payments that were originated today when that's not true. All these people that have older mortgages will have a different mortgage payment.
If you look at this chart, if you bought a house in 2012-13, your mortgage payment was about $1,100. Actually, median rent in the U.S. about $2,300. If you look at this chart, everybody who bought a house, like everybody, from 2022 and before that, are all bought the house for less than today's rent.
Sure.
Because their payments haven't changed, but rents have gone up to exceed them. Now, maybe the year they bought it, rent was $100 less, and everyone said, oh, you're so stupid for buying that house. That extra $100, I'm going to invest it in the stock market. I'm going to go put all my money into Blockbuster Video because that thing, I go there, that thing is packed every Friday night. Blockbuster Video, put it right now. Put down the date, 1999, Blockbuster Video, put all your money into Blockbuster, right? Okay. So the premise of this, and we're going to go back because I have another piece of data here, is that the housing market's going to crash because everybody is like overpaying for these houses and their payments are so high they're just going to walk. But the truth is 40% of people own it free and clear. Most of the 60% with loans have far less than $2,800 a month, which is what this says. And actually, we know the number. The median of mortgage payments is actually somewhere between $1,600 and $1,700.
Right, but you also have to consider that most people have a considerable amount of equity. So if people have equity, there's no reason for them to walk away from the house and have the house be foreclosed.
And there's also no reason if you have a median house and it's $1,600, $1,700, and rent would be $23. Why would you want to give that up to go then rent a house? Like, oh, I can't make the mortgage payment. I'm just going to let the bank take it back because it's cheaper to go rent down the street. No, it's not. It's going to cost you more money. I just won't pay them either. Well, then no one will rent to you or you won't get a house, right? Okay, Juana, put the chart back up. We have pretty much, like, the way this is done, especially with like his arrows, and oh, this was a crash and this was this, makes it look, I'm not saying that Look, interest rates are the highest. This was the highest run up in interest rates we probably have ever had in the last 30 years. 30 years to go from 2 to 6.5.
Yes, except
it actually went up to 8.5, and we're down to about 6.5 right now.
The highest run up was 81, 82, but yes.
Yeah, but I'm saying in the last 30 years.
Yes.
Actually, in the last 40 years, because that takes us back to 1985. Interest rates started coming down by then.
Yes.
Okay. So what's interesting is if you want to compare, if you go back to the 70s versus 1970s inflation, it looks the same, but then it says 1980 to 2000 stable. That's 20 years. Mm-hmm. So maybe we're going to have 20 years where your monthly payment will be stable. Mm-hmm. But if interest rates drop, but you're still paying $2,800, doesn't that mean it's interest rates are lower? That means home prices are higher, right? Because if home prices drop and interest rates drop, that $2,800 is going to drop too, right?
So if interest rates drop, then people will refinance, and their mortgage payment will drop. It'll drop for two reasons.
Okay.
It won't just be the interest rate. They will be financing a lower amount. So let me give you an example. So let's say that you borrow $100,000, right? And you make payments for, let's say, 5 years, and maybe now you owe $90,000. When you go to refinance, you're only refinancing $90,000, not $100,000, and you're getting a lower rate. So your payment will drop a lot more than just from the interest rate. It'll drop because you're also financing a lesser amount.
Here's another thing to think about. Let's talk about the 4 million people who will buy a house in the next 12 months. Mm-hmm. A good portion of them, I think, 30% will pay cash because they're investors or they pay cash, right? Okay. Another large percentage of that will put something down. They won't just 100% finance this, mm-hmm. right? We know historically that only about 15% of all mortgage originations, mm-hmm. not all home buyers, mm-hmm. mortgage originations, which ends up being less than 10% of all purchases in a year, or FHA loans, which means they're probably only putting 3.5% down.
Right.
Those are the riskiest loans, but they're also the smallest percentage of loans.
Right. So not only are they the smallest percentage of loans, but they're also generally the lowest price point.
Right. Yeah, because you can't get an FHA loan for like $1 million in most markets.
Yes, and most people would choose to not get an FHA loan if they can get a different type of loan, because generally they'll get a better rate. They won't have to pay mortgage insurance and so on.
Right. Are there some people that are maybe in over their head that bought the house? It's possible. Well, but when you look at...
Right. I mean, that happens in every market. It doesn't matter what the interest rates are. Even if interest rates were zero, you could still have people who are in over their head. Right.
But when you see most of the people either own it free and clear or have 5% lower rates and half the loans out there is $1,600 and less. And remember, this is including all loans. So this is like some person that bought a $2 million house and got a loan on it. They're included in that number.
Right, because they all kind of get lumped together and then divvied back up. Yeah, so that means that, there are people who have loans whose payments are maybe under $1,000. There are people who have loans whose payments are maybe over $5,000. So it all kind of comes out in the wash.
The reason why we're talking about this chart is it's just, you can see the fakeness of picking one metric and then scaling it in such a way to make it look like, oh my gosh, I can't believe, especially with the arrows and the other stuff, and then not taking into account that interest rates are up. Mm-hmm. If you look at a home price chart, it looks nothing like this. A home price appreciation chart from 1950 basically looks like that. It actually looks less drastic than the stock market. If you adjust it for inflation and wages, home prices and payments are basically the same. We just went through the numbers. Mm-hmm. The payments are a percentage of the same amount of income. So 4 million people are going to buy a house in the next year. There's 300 something million people. Mm-hmm. All the people say, how can anybody buy a house? They're not buying houses, right? Because they can't afford to buy houses. Only 4 million people are going to buy. Who are those 4 million people? Tell me on average who they are. Are they people just making $4,000 a month?
So these are people who, for their market, make, to your point, at least the average income wage for their market. Because, we talked about how the average wage for a household, not for a person, but for a household, in the U.S., you said it was like $80,000 or something like that.
Right. So that means that, let's say there's 300 million Americans that earn income. I don't know what the number is. Let's say it's only 200 million. Let's say only 200 million of the 400 million Americans earn income, right? That means 100 million make more than 80,000 a year. But only 4 million people are going to buy a house.
Right.
So the premise here is it's all these 80,000 people paying these $2,800 a month. But in fact, as we know, because we've worked with a lot of of these people make a lot of money, like $30,000 a month, and they're buying a house and mortgage payments $4,000 or $5,000, and it's well within their means. Right. I'm not saying everybody's like that, but we're just saying this chart is a chart of extremes. They've picked basically this little sliver, and then they've blown it up, and they haven't given you the other data that would basically show that this is not really as big of a deal, especially when you see the difference in income between 1950s, where you're only making $275 a month, versus now you're making over $6,000 a month.
So the point of this is perspective, right? When you see a chart, when you see an article, when you see information, like, take a moment and try to figure out the perspective in the whole thing, because that helps you understand the meaning of the data and helps you apply it to your life. Because otherwise, it's forever the sky is falling, because a lot of times people just want you to stay on their page, stay on their channel, whatever it is. That's how they monetize things, and that's great, and I'm all for people making money, and that's fantastic. What's important is that you get accurate information, that you interpret it correctly, so you can make good choices for yourself and your family. If we wanted to 10x the number of subscribers and views, we should just switch to crash videos. We should just make charts like this and go screaming about how, oh my God, it's overpriced. I can't believe anybody in the world, like, who could afford $2,800? Like, nobody makes $2,800. I mean, the average income is only $275 a month, and $2,800. Nobody has that kind of money. Like, only Warren Buffett maybe has that, or Elon Musk has $2,800 a month. The average person doesn't have $2,800. Well, clearly, affordability is an issue for Elon Musk. He doesn't own a house. He doesn't own a house. So, look, if Elon Musk can't afford a house, nobody can. He's waiting for the 70%. This guy has predicted numerous 30 to 70% home price crashes every year since 2019. Okay, not Elon Musk, the guy who made the crash chart. Bro that made the chart. Yes. Anyway, that was it. So hopefully you had some fun with the video. Please remember to subscribe, hit the notification bell, like the video, share the video, leave your real estate related comments down below, and we will see you on the next video. Bye. Bye.